Project 2 looks at an individual family's finances to determine how well the family is doing. We start by creating an income statement and balance sheet, then we calculate ratios and analyze their financial well-being, and finally we provide suggestions for improvement. A quick side note, I usually refer to the cash flow statement as the income statement. When we are dealing with personal finances, these two are used interchangeably. For any accounting or finance majors, or anyone familiar with corporate financial statements, this can seem odd, but in personal finance we do not have accruals or GAAP regulations, we just want to see how someone is managing their cash. For those of you who have no clue what I just said, please ignore it as it is not part of this class. So what exactly is an income statement? We are going to start by looking at some of the basics of an income statement. As its name implies, an income statement starts with income. This might seem simple, but there is a lot going on here. Income can include salary, hobby income, tax refunds, government assistance, family support, or anything else that puts money into your pocket. From income, we subtract our expenses. We will look more in depth at this later, but for now, think of expenses as everything that I have budgeted for throughout the year. We do not talk much about budgets in this class, but you should know some of the basics. I know I'm going to buy food, pay my bills, spend some money on entertainment, and save some money for later. After we subtract our budgeted expenses, we are left with our cash surplus or deficit. This tells us how much cash we made during the year that we did not spend, or how much we spent in excess of what we earned. Now let's take a closer look at expenses. Expenses are split into two categories, fixed and variable. Fixed expenses are items such as loan payments, insurance payments, and rent payments. The key to determining if something is fixed is to remember that fixed expenses are outside of my control. Although I can change these expenses over time, for the next year or so they are not going to change. They are going to be the same every month, and I have the option of paying them on time or becoming homeless, carless, etc. Any fixed debt payments that I have will fall here. If I have a $100,000 boat loan, I would see my monthly payment here. Note that this is only fixed debt payments. There are variable debt payments as well, such as credit cards, home equity loans, and overdraft lines of credit. We will talk more about these later in the semester. I mentioned that credit card payments are variable expenses. Some other examples are groceries, entertainment, and even utility bills. Why? Utility bills for most people are different every month, which makes them variable. But there are people who have budget billing and pay the same amount every month, with the exception of 1 month for adjustments. If you pay the same every month, the important thing about your utility bill is that, like all my other variable expenses, they are something I can control. If I am struggling financially, one of the first things I can do is look to cut variable expenses. If I have my air conditioner set to 74 degrees instead of 70 degrees, I can save a lot of money. Likewise, I can buy cheaper groceries and cut my entertainment to improve my financial situation. So how about that past due utility bill? Where does that go? Yes, I do have to pay that, but that is a balance owed and not a monthly expense. So that will not show up anywhere on my income statement, but it will be on my balance sheet. Let's look back at our basic income statement. After we subtract our budgeted expenses from our income, we are left with our cash surplus or deficit. What is that? This is how much cash you have at the end of the day. If you made more money than you spent, you will have a surplus. If you spent more than you made, you have a deficit or negative cash flow for the year. This can include anything that is not in my budget. This is money I can use for trips to the Bahamas, impulse buys, or gifts to others. I could save this money or go on a major shopping spree. So, is this my annual savings? Not really. If I want to set aside some amount of money every year, I would include that as a variable expense because I am budgeting to save money every year. And that's it for the income statement. It's rather simple when you look at the big picture and think in terms of your annual budget.